Yep, 402. All right. Well, thanks for joining us, everyone, for our quarter number 2 market update. And just so you know, if you haven't been on one of these in the past before, we do these every quarter. The idea is to give people an update of where we've been and where we think we are going in the future. So, Ryan, you want to click to the next slide, and then I'll introduce the team. Not all of us are on the call today, but our Raymond James E&M Consulting CKE Financial Services team. We've got 5. We're at 5 advisors now and 3 support staff. And if you haven't been here before, we're right here in Westlake at Crocker Park. And again, if you haven't been here before, by all means, reach out to one of us. We can have you come in, check out the office, show you around, and introduce you to everyone. One thing I like to point out on this slide is you may know us as Raymond James, you may know us as E&M Consultants, but the CKE portion of our name is because we're the financial planning partner of Corrigan Krause here in Westlake. We've got over 100 years of experience collectively, and we specialize both in 401k plans, retirement plans, and working with individuals, hence the CFP designation for the 3 of us. If there's any questions throughout, we're going to try to keep this to about 30 minutes or 28 minutes, take you to 4:30. Any questions, by all means, you can always reach out to one of us, or if the Q&A is enabled, if there's any questions, or as we go along, by all means, let us know. But hang on to our names and numbers going forward. I'm sorry if I didn't even say it, but I'm Brian Reese. So Brian Reese, and then I've got Scott Jones with us and Ryan Eierman with us as well. And we're going to kind of break this up and give you a little background on where we've been and where we think that we're going to go. And Ryan's going to wrap it up with some of the planning tools that we use. Now, everyone that's on the call, you're probably one of 4 types of people. You're either a 401k plan sponsor or an employee within one of the retirement plans that we manage, a personal client, or maybe number 4, not a client at all. But again, this is for information's sake. It's the little bit of our opinion mixed in with some of Raymond James' opinions. So just to plant that seed. So overview of the services. These are all the things that we can help you with, no matter which one of the 4 types of people you are. But we do employee one-on-one meetings. So if you run a 401k plan, you want more help for your employees, we do those sort of meetings on a regular basis for clients. Helpline, on-demand meetings. So we're almost always available, whether it's us directly or if you are part of a 401k plan, we have the record keeper that is available to you as well. On-site group education, so that goes as a part of the employee one-on-ones. Typically, we'll do the group meetings for our 401k plan and plan sponsors, and then the one-on-one meetings as well. Commentary and insights. Ryan, I think, will touch on the website a little bit, but we've got all kinds of information that we push out to clients. Our goal is to help educate and inform. So there's all kinds of information that's available to us that we make available to you as well. Dedicated ongoing financial planning support and additional financial planning tools. Ryan will hit on that again towards the end. But as certified financial planners, our goal is to help by taking a holistic approach and help people with their financial planning needs now and for generations to come. And then these quarterly market and economic webinars and updates, and the quarterly financial newsletter that goes out too. So a lot of good information that we get out to everyone. And it's nice because you can pick and choose what you really want to hear. You don't need to see or pay attention to all of it. So next up, Ryan. A couple of legal disclosures there for us. And then the overall agenda. So I'll take a minute, review the quarterly investment returns, again, looking backwards, and then Scott will jump in with some of the key themes and stock market outlooks. And then Ryan will jump in on the importance of diversification and resources that are available to you. But yeah, this, I don't know if we can, Ryan, can you make that a little bigger? Do you think this is maybe the one slide that's kind of hard to see? But the idea here is to take a look back and just give you an idea. If you're not paying close attention, give you an idea of where you've been or where we've been collectively. The first box on the upper left, this is the fixed income. So as in the gray says, rising yields push fixed income lower, and you can see just on the 2023, there's a lot of red here. So I'm not going to dig in too much, but you see in the short run where fixed income has been. So more on the downslide, and then also with commodities as well. If we're just looking more recently at the second quarter, you can see all the red there. Things like gold and precious metals, crude oil. So a lot of red there, and even on the year to date, some more red than anything else. Down bottom left, this is where we see some of the winners really start creeping in. This is the S&P 500 sectors. Maybe no surprise to people. Information technology overall, it has been leading the way when you think of companies like Apple and Microsoft and Netflix and Google. So a lot of and Tesla, and a lot of those things leading the way. But second quarter information technology alone was up 17%. You can see the year-to-date number on that is 42%. Further over to the right, you can see longer term numbers, but definitely technology still leading the way for us. Top right is where it's shown as growth outperforms value. Really, there's a number of things in there, but the second line down is what most people would say is the most widely used statistic or indice to show us how the U.S. market is doing. So you can see the S&P 500 for the quarter was up 8.7%. Year to date, up almost 17%. And I don't know if Ryan and Scott would agree, but I feel like a lot of people are a little bit surprised by that. A lot of people don't realize how well the stock market has done. This is through the second quarter. Year to date now, the S&P is up over 18%, so still going strong. And then the Dow Jones, if we skip down a few to the Dow, that's up 3.4% on the year, or about the same on the quarter, about the same, close to the same on the year. If we go further or go back up top to the S&P 500, if you think back 10 years ago, that takes us to 2013, and since then the market's averaged about 13%, so pretty strong. If we skip down to the bottom for a second, this gives the numbers. So this tells us where the markets have been. So the Dow, as of the end of June, we were at 34,400. I can't read that. So yeah, 34,408. Whereas the S&P was at 4,460. Think about this though, when you look back over the 10 years ago, the Dow from 34,000 now, it was over 14,000 10 years ago. S&P 4,450 or 60 now was 1,600 10 years ago. So when you think about the growth that we've seen over a 10-year period, that's pretty amazing. Even though that's factoring in years like 2022, which were as you guys all know or probably know, not a real good year in the market. So this is just a little taste of where we've been. Again, Scott will talk a little bit more about what we think is going to happen going forward, but that's all I've got there.
All right. Thanks, Brian. Scott Jones with Raymond James Advisor, Certified Financial Planner. So really what I wanted to do is just touch on a couple of key themes that we're seeing, things that you would see in the headlines, news articles, that are, headline news. But really, it's been a good year in the market overall. I think the key theme that everybody is really focused on is inflation. Continues to be front and center of all the conversations. in this space. You hear a lot about the Federal Reserve interest rate increases. So we've seen short-term rates jump up fairly significantly in a short period of time, which impacts a lot of things in this update. Brian talked about fixed income and bonds being down. It's largely due to the increase in rates. So all of that is the Fed trying to tame inflation, get inflation under control, because it's a difficult job. Once the saying goes, once the toothpaste is out of the tube, it's very difficult to get back in. So you see the Fed continuously to focus on that. So there's going to be news this week about potentially another rate hike, and potentially maybe in September. So we do anticipate that will slow down over time, and but it's going to be the kind of front and center key theme that we continue to hear about. It's impacting a lot of things. We do have money market rates now upwards of 5%, where if you think about our savings accounts over the last 10 years plus, we really haven't gained any interest on a checking or savings or CDs. Nobody really had an appetite or interest in owning any of those because the rates were effectively zero. But it's impacting things like mortgage rates, car loans, and those rates are going to have an impact on the overall economy, with the goal of taming inflation, slowing the economic growth. So over on the right of this chart, you see this is our firm's Raymond James Investment Strategy Committee's current positioning. So we have a neutral on equity stocks. We have a little bit of overweighting on fixed income. And a lot of that is due to the fact that the rate hikes should slow down. And if we do get into a period where rates started dropping, it would be a positive environment for fixed income and bond funds, and bonds in general. So a little bit of overweight there. Commodities neutral, and cash is slightly underweight. So some other themes you hear about, Brian talked about technology. That's obviously kind of been the flavor of the year. You're hearing a lot about artificial intelligence. AI has been a lot of conference calls talking about that. So you've seen some of the market leaders in technology really be responsible for a lot of the performance this year so far. Some of the big names: Microsoft, Apple, Alphabet, Amazon, everything really dealing with artificial intelligence. And so we'd like to see a bigger, broader broadening out of the market returns and see different sectors participate. So that's what we'll be focusing on probably from now and through the end of the year. So Brian, if you want to move to the next slide. Just a chart we use a lot in our educational meetings, and it's going back to 1980 on the S&P 500 returns. So these are the calendar year results of the S&P 500. And we spend a lot of time talking about it because whenever we're thinking about investing, whether it be in a 401k or an IRA, college savings, a large portion of our investment is in the stock market, US stock market mainly. And the reason for that is it's provided almost upwards of 10% gains, and Brian shared some of those results fairly consistently. So 32 out of 43 years, we've had positive results. It's almost just under 75% of the time we've gained money or made money in this investment. So, it doesn't mean that every point during the year the market is positive, and that's kind of what this chart is trying to show you. The dark gray bars going up are year-end 12/31 results, and the red dots that you see below line, horizontal line, is those are times during the year where we have an inter-year decline. So earlier this year, on the far right, you can see the market was actually down 8% at some point. And through June 30th, it's up 16%, probably closer to 18%, as Brian mentioned now. So, and then you can see last year, we finished down 19% in the S&P. But at one point, we were as low as the red dot is minus 25%. So this should be viewed positively, and it continues to provide great returns for long-term investors. And, you know, I think the average here is showing about 8.7%, but when you factor in dividends that stocks pay, you know, we get closer to a 10% average return. So we'll see where we go from here, but just about every 3 out of 4 years, we're looking at positive returns in this investment. So Brian, if you can go one more forward. So our outlook for the year, we came out at the beginning of the year. It's stayed consistent. We came out with a price target at the end of the year of 43.95. So we're actually, as of June 30th, above that slightly. You can see we're at 4,450 on the S&P. So the market is really, you know, shot to the upside here for the first half of the year. We'll have to see what happens for the remainder of the year, but a lot of this is just predicated on earnings, companies selling goods and services, making a profit, and you hear things like earnings per share, and then we come up with a reasonable multiple on what the S&P has been traded at long term, and then you can see we have a base case projection of $215 of earnings for S&P companies for the year, with a price earnings multiple of 20, and that gets us to about a 4,400 price target for the end of the year. So Ryan, if you go one more. This is we've already started to kind of factor in next year. So if you're interested in what our 2024 outlook might look like, this is just a little scenario of that. So, you know, we think that there's going to be modest GDP growth, 7.7%. You know, that's lower than a historical average. You know, we try to, it's usually around a 2 to 3% GDP growth, but even though economic growth is projected to be tamer, and a lot of that is based on what we talked about earlier with, you know, Fed trying to slow things down, we think that a PE multiple of 21, 22 times is reasonable. That would get us to a price target at the end of next year, 12/31/24, between 46.20 and 49.50. So again, that's just somewhere between a 20, 23 time multiple. That's the rectangular box is the earnings of the S&P 500 stocks, and then we get to a multiple, a long-term PE multiple of 20, 21 times. So again, it's not, it's positive, and we continue to think it's a good time to be invested in the market. You know, we'd like to see things broaden out a little more. And what I mean by that is have more participation than just technology, like Brian covered, financials, you know, industrials, things like that. And, you know, we always have 5-10% corrections throughout the year. So it wouldn't be unnatural to see something like that occur over the next 6 months. But long term, we still continue to have a higher outlook on the equity market. So that's all I had on that, Ryan. You want to take it over?
Thanks, Scott. So one of the other things that we track each year is the returns on individual asset classes. So what this chart is tracking is basically fixed income, cash, high yield, small cap stocks, large cap stocks, commodities, real estate investment trusts. And we have developed markets, equity, and emerging markets. And this tracks back from 2008 to current. And really what this chart is trying to show you is that if you look at the white boxes, this is a diversified portfolio, and the returns year over year. And it shows you that with a diversified approach, you're getting sort of a smoother path to returns than you would otherwise have if you were invested, say, in everything in one asset class. As you can see, if you look at something like emerging markets, in 2011, we see that it had a negative 18% return, so all the way at the bottom there. And then in 2012, it's all the way up at 18.6%, and then the following year, it's back down close to the bottom. So pretty volatile if you were invested in one asset class, but this is really just to show the benefit of diversifying and how that can smooth out the volatility of your returns over time. So this next slide is looking at sort of the main options that you'd have as an investor if you're investing in really a 401k or most tax deferred accounts. So on the right, you have sort of the riskiest option, which would be investing in your own investment choices, doing your own stock picking. And then on the left, we have sort of hands-off approach, totally managed for you, would be something like a target date fund, which as you approach retirement automatically gets more conservative for you over time. And then in the middle, we have risk-based portfolios, which would be sort of a good midpoint between those two. You would still need to go through each year and evaluate how things are doing and possibly move more towards the conservative style portfolio as you move along towards retirement. But it would be a more managed approach than, say, picking all your own stocks. And then this slide just goes into our investor profile. This would be a good place to start for most investors if they're not sure what type of portfolio they should be in for their age bracket. This is going to look at your time frame to retirement. What style investor are you? Are you more conservative, more aggressive? And then how much experience you have with investing. And just by going through this questionnaire, we're able to help you kind of narrow down what portfolio would make sense for you. And then we did want to touch on our website. We do have a lot of resources out there, all the way from blog posts covering the economy and market updates, all the way to calculators that can help you determine how much you should be saving for retirement or saving for college education for your kids. So that's a good resource that we have out there, CKEFinancial.com. And then we also did want to mention our financial planning software that we have in-house. It's called Goal Planning and Monitoring. If you are looking to prepare for retirement, or even, let's say, prepare for saving for your kids' education, or even just planning out Social Security, things like that. This is a service that we offer. I believe Brian mentioned it earlier, but can be very helpful for planning out things like that. So I think that's it for me. Scott, Brian, did you guys have anything else you wanted to add to that?
Yeah, I would just say, kind of reiterate a couple of things. One, the overall stock market has done pretty darn good this year, largely led by a handful of large technology companies. So if you're in a diversified portfolio, properly diversified portfolio, your accounts have probably done pretty well this year, and you're probably still pretty well positioned. Now, of course, check with us, check with your financial advisor to ensure that's the case. But overall, markets look good. Fed's probably going to raise rates again here in the near future. But yeah, I would say just keep an eye out on for our newsletters, our ongoing webinar series. Reach out to us with any questions. Scott, anything you want to close on?
No, I think I just appreciate your time for those who attended, and we'll be doing these every quarter. It goes by fast, so there's always something to talk about, but we hope that these calls can, no matter if you're in a 401k or an IRA, or what you're saving for, or maybe you just you want to be more educated about these things in the future. We hope you find this information helpful. You never know when you might come into a situation where you now have to make investment decisions. And so I think this is helpful for everyone. I also think, we talked about the results of the market over time. There will be another time when the markets aren't doing so well. And so I think if you have a better understanding of how it works, some of the historical performance history, it helps us, stay calm, don't panic, make rash decisions, because being an informed investor. So that's what we're trying to accomplish here, and we look forward to future calls. So.
Yep, awesome. Thanks, guys.
Yep.
Thank you.